Imagine this. You finally decide to fix that outdated kitchen or leaky roof, and you get an estimate. Then you see the number. Your dream project suddenly feels impossible. But here's the twist. What if I told you there's a way to get the money you need without draining your savings or maxing out your credit cards? That's where home improvement loans come in. And by the end of this video, you'll know exactly how they work the smart way to use them, and one critical mistake you must avoid that could save you thousands of dollars. Number 1. What exactly is a home improvement loan? A home improvement loan is money you borrow specifically to fix or upgrade your house. Think of it as fuel for your remodeling project. You borrow now, then pay it back over time with interest. There are two main types. One is unsecured, which means no collateral is required, kind of like a personal loan. The other is secured, which means your home is used as collateral, like a home equity loan or line of credit. For example, if you borrow $20,000 as a personal loan to redo your kitchen, the lender can't take your house if you fail to pay. But if you take out a home equity loan for the same amount, your house is on the line. Number 2. Why people choose home improvement loans? The number one reason is simple: cash flow. Most Americans don't have $30,000 sitting around for a new roof or $15,000 for a bathroom remodel. A loan makes the project possible now, while spreading payments out over years. Another reason is boosting your property value. If you spend $20,000 upgrading your kitchen and it raises your home's value by $25,000, you've not just improved your living space, but also your financial position. A family in Ohio took a loan to finish their basement. It cost them $18,000. 2 years later, their home appraisal showed an increase of $25,000. That's the kind of smart investment these loans can create. Number 3. How do these loans actually work? When you take a home improvement loan, the lender gives you a lump sum or access to credit. You agree to repay it over a fixed term, usually with monthly installments. For example, if you borrow $10,000 at 8% interest for 5 years, your monthly payment might be around $200. At the end of 5 years, you're debt-free. With a line of credit, it works more like a credit card. You can borrow as needed, up to your limit, and only pay interest on what you use. This is great for long projects where costs come in stages. Number 4. The different types of home improvement loans. There are 4 main ones you need to know. First, personal loans. These are unsecured and fast. Approval can happen within days. No collateral needed. But interest rates are usually higher, sometimes between 6 and 36%. Second, home equity loans. These let you borrow against the equity in your home. Equity is simply the difference between what your house is worth and what you still owe on the mortgage. Example: if your home is worth $300,000 and you owe $200,000, you have $100,000 in equity. Banks might let you borrow up to 80% of that. Third, home equity lines of credit, also known as HELOCs. They act like a flexible credit card backed by your house. You only borrow what you need when you need it. Fourth, government-backed loans. For example, FHA Title I loans allow homeowners to borrow up to $25,000 for improvements without requiring equity. This can be a lifesaver for newer homeowners. Number 5. Which loan is right for you? If you want speed and have good credit, a personal loan may be your best option. It's simple and fast. If you have built up equity and want lower interest rates, a home equity loan or HELOC could save you a lot of money. For example, someone with strong credit might get a personal loan at 10%, but a home equity loan could be at 6%. On a $20,000 loan, that's a difference of nearly $4,000 in interest over the life of the loan. If you don't have equity yet, government-backed loans may open doors you didn't know existed. Number 6. What do you need to qualify? Lenders look at 3 main things: credit score, income, and debt-to-income ratio. For personal loans, most lenders want to see a credit score of 600 or higher, though better rates start around 700. For home equity loans or HELOCs, lenders also look at your equity. They want to know you own at least 15 to 20% of your home's value. Debt-to-income ratio is also key. If you earn $5,000 per month and already have $2,000 in debts, adding another loan could push your ratio too high. Most lenders like to see debt payments below 40% of your income. Number 7. The pros and cons you must weigh. Let's start with the pros. You get the money to upgrade your home now. You may increase the value of your home. Interest rates can be lower than credit cards, and repayment plans are structured, which helps you budget. Now the cons. If you use your home as collateral and can't pay, you risk foreclosure. Interest still costs money. A $20,000 loan at 10% for 5 years will cost you about $5,000 in interest. And if you borrow more than you can afford, you'll end up stressed and financially stuck. One couple in Texas borrowed $40,000 for a pool. 5 years later, they realized the pool only added $10,000 to their home value, but they still owed thousands in interest. That's a financial regret you want to avoid. Number 8. Smart ways to use a home improvement loan. Focus on projects that either increase your home's value or improve quality of life. Kitchens, bathrooms, roofs, and energy-efficient upgrades are usually good bets. For example, the National Association of Realtors found that kitchen remodels can return about 70% of their cost in added value. Energy-efficient windows can reduce bills and make your home more attractive to buyers. But luxury add-ons, like a home theater or hot tub, may give you enjoyment but little financial return. Ask yourself, is this project an investment or just a nice-to-have? Number 9. How to avoid costly mistakes. Mistake number 1. Borrowing too much. Just because the bank offers you $50,000 doesn't mean you should take it. Mistake number 2. Not comparing lenders. The difference between an 8% loan and a 12% loan on $20,000 is thousands in extra payments. Mistake number 3. Not planning for surprises. Renovations often cost more than expected. Always borrow a little cushion, but never more than you can realistically handle. Mistake number 4. Forgetting the long term. A 10-year loan may lower your payments, but you'll pay much more in total interest compared to a 5-year loan. Number 10. Alternatives to home improvement loans. Before you commit, consider other options. Savings. If you can wait and save, you avoid debt completely. Cash out refinancing. This replaces your mortgage with a bigger one, giving you cash up front. Rates are often lower, but you restart your mortgage clock. Credit cards. With promotional rates. If you need a small loan and can pay it off quickly, a 0% interest card could work. But miss a payment and interest skyrockets. Grants or local assistance. Some states offer funds for energy upgrades or essential repairs. Number 11. How to actually apply. The application process is straightforward. Step 1. Check your credit score and reports. Step 2. Gather documents like income statements, proof of home ownership, and estimates of project costs. Step 3. Shop around. Compare offers from banks, credit unions, and online lenders. Step 4. Apply and wait for approval. This can take days for personal loans or weeks for home equity products. Step 5. Once approved, the lender gives you funds or access to credit. Then you can start your project. Number 12. The one critical mistake you must avoid. Here it is. Never assume your home improvement loan is automatically a good investment just because it improves your home. Some projects will add value. Others won't. Borrowing $30,000 for a new kitchen could add $25,000 in value, making sense. But borrowing the same amount for a luxury sauna that adds zero value leaves you with debt and no return. Always match the loan with a smart project. That's how you turn borrowed money into financial growth instead of financial regret. Number 13. How much can you actually borrow? The loan amount depends on the type of loan and your financial profile. For personal loans, most lenders cap the amount between $1,000 and $50,000. For home equity loans or HELOCs, you may be able to borrow up to 80 or even 85% of your home's equity. For example, if your home is worth $250,000 and you owe $150,000 on the mortgage, you have $100,000 in equity. A bank might let you borrow up to $80,000 of that. For government-backed options, the limits are usually lower. FHA Title I loans cap out at $25,000. Number 14. How long do you get to repay? Repayment terms vary widely, and the term you choose affects both your monthly payment and total interest. Personal loans usually offer 2 to 7-year repayment terms. Home equity loans can stretch from 5 years up to 30 years, similar to a mortgage. HELOCs often have two phases: a draw period, usually 10 years, where you can borrow as needed, and a repayment period, which can last another 10 to 20 years. Choosing a longer term lowers your monthly payment but increases the total cost. A $20,000 loan at 7% interest will cost about $4,000 in interest over 5 years. Over 15 years, it could cost more than $12,000. Number 15. What about taxes? Here's where many people get surprised. Interest on personal loans is generally not tax deductible. But if you take a home equity loan or HELOC and use the money specifically for home improvements that raise the value of your house, the interest may be tax deductible under IRS rules. For example, if you borrow $30,000 through a HELOC to add a bedroom and increase your home's value, you could deduct that interest. But if you borrow the same $30,000 and use it to pay off credit cards, you cannot. Always check with a tax professional before assuming the interest is deductible. Number 16. How fast can you get the money? The speed depends on the loan type. Personal loans can fund as quickly as 1 to 5 business days. That makes them great for urgent repairs, like fixing a furnace in the middle of winter. Home equity loans and HELOCs take longer because they require appraisals and more paperwork. Expect anywhere from 2 to 6 weeks. Government-backed loans also take time, often a few weeks, because of the extra rules and documentation. If speed is your main concern, personal loans win. But if you want lower interest rates and can wait, equity-based loans may be worth the delay. Number 17. What happens if you sell your home? This is a question most beginners never think to ask. If you still owe money on a home equity loan or HELOC, that balance usually must be paid off at closing when you sell the house. For example, if you sell your house for $300,000 but still owe $20,000 on a home equity loan, that $20,000 will be taken from the sale proceeds. Personal loans, however, are not tied to the house. You keep paying them off even after selling. This is important if you plan to move within a few years. Taking a large home equity loan right before selling could create problems. Number 18. Can these loans hurt your credit? Yes, they can, but they can also help. When you apply, the lender performs a hard credit inquiry, which can lower your score slightly. Taking on new debt raises your overall obligations, which may impact your score if it pushes your debt-to-income ratio too high. But making consistent, on-time payments builds your credit history and can improve your score over time. For example, someone with a credit score of 650 might see a small dip after taking the loan, but after 2 years of steady payments, their score could rise above 700. Number 19. Do lenders restrict what you can spend the money on? This depends on the loan type. With personal loans, you generally have freedom. You can use the funds for almost any home-related expense, from roofing to landscaping. With home equity loans or government-backed loans, there may be restrictions. For example, FHA Title I loans cannot be used for luxury items like swimming pools. They must go toward projects that improve livability or safety. Always read the fine print to make sure your project qualifies. You started this video wondering if a home improvement loan could make your dream project possible. Now you know what they are, how they work, the different types, how to qualify, the smart ways to use them, and the costly mistakes to avoid. So here's my question for you. If you had access to a home improvement loan right now, what would be the very first thing you'd fix or upgrade in your home?